Pleasant day to all. For this video presentation, we will discuss all about the international flow of funds. Basically, it takes place when buying and selling of goods and services occurred between the international market by means of export and import from one country to another country. The transactions of international business cause the flow of funds from one country to another and helps into money to flow from one to another market. With that, you will obtain fundamental knowledge about the basic concepts about international flow and funds. Moreover, you will gain relevant knowledge how it works to help the organization sustainably operating in the international market. Furthermore, after this presentation, you will be able to explain the key components of the balance of payments, explain how the international trade flows are influenced by economic factors and other factors, and identify the different advantages and disadvantages of international flow of funds. International business is facilitated by markets that allow for the flow of funds between countries. The transactions arising from international business cause money flows from one country to another. The balance of payments is a measure of international money flows and is discussed in this chapter. Financial managers of MNCs monitor the balance of payments so that they can determine how the flow of international transactions is changing over time. The balance of payments can indicate the volume of transactions between specific countries and may even signal potential shifts in specific exchange rates. When we say balance of payment, it refers to a summary of transactions between domestic and foreign residents for a specific country over a specified period of time. It represents an accounting of a country's international transactions for a period, usually a quarter or a year. It accounts for transactions by businesses, individuals, and the government. The balance of payment can be in surplus or in deficit within a specific period of time. The surplus balance of payment will be recognized when the export transactions are more than the import transactions in a given specific period of time. On the other hand, when the export transactions are less than the import transactions of the country in a given specific period of time, it is set as deficit balance of payment. Let us identify the different components of balance of payment. These are current account and capital account. Let us differentiate the two components by explaining each. The first component is the current account. It represents a summary of the flow of funds between one specified country and all other countries due to purchase of goods and services or the provision of income on financial assets. In another definition, the short-term transactions of a country and the difference between the savings and the deposits aggregately constitutes the current account of the balance of payment. The transactions in the current account consist of export and import transactions of goods, export and import transactions of the services, money transfers and income from the factors like land and foreign shares. Let us discuss the different components of current account. The first component is the payment for merchandise and service. It will be represented through the balance of trade, which is the main component of the current account. Balance of trade is simply the difference between merchandise exports and merchandise imports. Take note that country can export and import merchandise and service. Merchandise exports and imports are commonly represented by tangible products. Some of the common examples are computers and clothing that are transported between countries. Service export and import are the intangible products such as legal, insurance and consulting services provided for customers based in other countries. For instance, service export by the United States will be considered as inflow of funds into the United States, while service imports will be considered as an outflow of funds into them. The second component is the transfer payment. It represents aid, grants, and gifts from one country to other countries. When the company purchased raw materials from other country, then they secure international payment. It also belongs to transfer payments. These kind of business transactions also affect the current account of the international company. The last component of current account is the factor income payments. It represents the income received by the investors on foreign investments in the financial assets. Consequently, the factor income received by the Filipino investors will reflect as an inflow of funds into the Philippines. Factor income paid by the Philippines will reflect as an outflow of funds from the Philippines. The second component of balance of payment is the capital account. It includes the value of financial assets transferred across country borders by people who move to a different country. It also includes the value of non-produced non-financial assets that are transferred across country borders, such as patents and trademarks. The sum of total inflow and outflow of capital that directly affect a nation's foreign assets and liabilities is aggregate constitutes a capital account. It includes all the trade transactions of international business between one country or a nation or the other country or nation. The following items are also included in the capital account of the balance of payment. Investments and loans of foreign countries. Banking and other forms of foreign capital and any changes in the foreign reserves. Take note that all the transactions that are related to the export services by one country result in the inflow of funds, and all the transactions related to the import services are the reason behind the outflow of the funds. Let us take a look at the components of capital account. Remember that components of the capital account includes foreign investment and loans, banking and other forms of capital, as well as monetary movements or changes in the foreign exchange reserve. The capital account flow reflects factors such as commercial borrowings, banking, investments, loans, and capital. Let us discuss the main components of the capital account. A financial account is a component of a country's balance of payments that covers claims on or liabilities to non-residents, specifically with regard to financial assets. The financial account is a measurement of increases or decreases in international ownership of assets. The financial account has two main sub-accounts. The first is domestic ownership of foreign assets. It measures money flowing out of the country to purchase foreign assets. If this increases, it subtracts from the financial account. The second sub-account is foreign ownership of domestic assets. It measures money flowing into the country to pay for the asset. If this increases, it adds to a country's financial account. The financial account components are similar in each sub-account. The only difference is whether the asset is owned by someone in the country or a foreigner. Domestic ownership of assets further divided into three types of ownership: private, government, and central bank reserves. No matter which entity owns the foreign asset, increases subtract from the financial account. Let us focus on the private owners. Can be either individuals or businesses. Their assets include deposits at foreign banks, loans to foreigners, securities of foreign-owned companies, direct investments made in foreign countries, commodities, such as gold, held in other countries, foreign ownership of domestic assets. This sub-account is further divided into two types of ownership: private and foreign official assets. When foreigners increase their ownership of a country's assets, it adds to the financial account. These domestic assets include deposits owned by foreigners held at the country's banks, loans made by foreign banks to domestic banks, foreign private purchases of a country's government bonds, corporate securities, such as stocks and bonds, owned by foreigners, foreign direct investment, such as reinvested earnings, equities, and debt, other debts owed to foreigners, hard assets, such as gold and other commodities, the country's currency. Foreign official assets include assets mentioned above that are held by foreign governments or foreign central banks. Net shipments of the country's currency to foreign governments or foreign central banks. Take note that the financial accounts measure the change in international ownership of assets. This should not be confused with the income, such as interest and dividends, that is paid out on the assets owned. That is measured by the current account. Moving forward, financial account also composed of the following: direct foreign investment, portfolio investment, other capital investment. When we say direct foreign investment, it represents the investment in fixed assets in foreign countries that can be used to conduct business operations. Examples of direct foreign investment includes firms' acquisition of a foreign company, its construction of new manufacturing plant, or its expansion of an existing plant in a foreign country. Portfolio investment. It represents transactions involving long-term financial assets, such as stocks and bonds, between countries that do not affect the transfer of control. Other capital investment. It represents transactions involving short-term financial assets, such as money market securities, between countries. Now, let us move forward to the discussion of international trade flow. Trade flows measure the balance of trade, exports minus imports. This is the amount of goods that one country sells to other countries minus the amount of goods that a country buys from other countries. This calculation includes all international goods transactions and represents a country's trade balance. The following are the influential factors affecting the trade flow. Impact of inflation. If the inflation rate of a country increases as compared to the other countries with whom they trade, then the value of the current account will decrease after taking an assumption that all the other factors are constant. In this case, the country's exports will decrease because of the inflated prices and the imports of the country will increase as the local companies will also purchase products from the overseas market where there is low rate of inflation to minimize their purchasing costs. National income. If the gross domestic product of a country increase, the per capita income of the people of the certain country will also increase, which leads to increased consumption as spending of the country. Moreover, this will definitely increase the demand for the imported goods and will give adverse effect on the balance of payment of the country. Government policies of a country. The government policies of a country greatly affect the trade between two countries at an international level. The policies of a country either help them or restrict them to do import and export transactions with the other countries that can totally change the conditions of the balance of payment and balance of trade. This also determine the growth pattern of one nation. This is one of the most relevant factors that affects and controls the flow of funds from one country to the other, which constitutes the international trade and international flow of funds. Subsidies provided for traders. The rate subsidies decide the volume of exports in a country. If a country promotes exports in its country, then it tends to provide a lot of subsidies on international trade and mainly on the export activities. For instance, in India, huge subsidies are provided on the exports of goods and services to any other country. Another example is China, where they receive free loans and the free lands from the government for the production of goods and services that can be exported in future. Take note that these subsidies are helpful for a country's exporters and importers to capture the larger share of the global market. Restriction on imports. If the government of a country enacts substantial responsibilities on the imports and related activities in their countries, then it will help the country to improve their balance of payment position, as the public will not be able to purchase the goods and products from the other countries. On the other hand, if the country imposed less obligation on the imports, then people of the country will import more and more from the other countries and will adversely affect the balance of payment position of a country. Restrictions on the piracy. In some cases, a government can affect international trade flows by its lack of restrictions on piracy. Impact of exchange rates of foreign currency. Each country's currency is valued in terms of other currencies through the use of exchange rates so that currencies can be exchanged to facilitate international transactions. If the foreign currency in which the export or import transactions takes place more fluctuates at a higher level, in that case, the balance of payment for that specific period will also fluctuate at a greater extent and somehow equal to the extent of changes in the foreign currency in the international market. Let's move forward to the discussion of advantages and disadvantages of international flow of funds. The identified advantages of international flow of funds are the following. Increase aggregate demand. The overall product demand will increase if the international flow of funds is allowed in a country. Before the implementation of globalization all over the world, the demand for the local products were not so good and a lot of companies were experience a huge organization failure. Then, when the implementation of the trade flow was allowed, the demand for the local, as well as international product begun to increase, and most of the manufacturing companies emerged as big giant industries at that time. Increased production capacity. After the globalization period, more countries industrialized as a manufacturing hub. The existing production capacity of the countries also rise as they now had buyers for their products in a huge quantity, which lead to increased profits. Thus, their production capacity subsequently increases as well. If in case the flow of funds from one country to another is limited in future, many of the manufacturing companies will be at the boundary of crisis and the economy of many countries will crash. Technological advancement. If the import and export from one country to the another is easy and promoted, the country also becomes technologically advanced. This is due to the new and innovative technology can easily float from one country to the another. On the other hand, if the import and export policy from one country to the other is restricted, then the country becomes obsolete or outdated in terms of the technology and innovations. The surplus on the financial account of the balance of payment, capital inflows from any other country can help to finance a current account deficit. With the help of attracting capital flows from the international market, it enables one country to effectively import more goods and services. Without these capital inflows, a current account deficit would lead to a deflation in the exchange rate to restore stability in the balance of payments. Easy finances. In the international market, the flow of funds is very easy and it assists the domestic companies and even government to raise funds from outside the country, which is easier through the help of the flow of funds from outside the country or by means of foreign direct investment. The inflow of foreign currencies. The international flow of funds helps the country to get foreign currency easily, as all the transactions of imports and exports take place in the foreign currency only. Here are the disadvantages of international flow of funds. The loss to domestic players. Internationalization of flow of funds, that means the promotion of imports and exports transaction can destroy the market of domestic players. The domestic market gets affected when the international player enters the domestic market, given the fact that imported products and services are more advanced. Tax evasion. International companies like Facebook and Amazon move to the countries that have lower tax foundations. The companies save their expenditure on corporate taxation by operating in the underdeveloped and developing countries where the tax on doing business and related activities is very less. Destroying the real estate market. The international flow of funds can also be in the way of purchase of assets or real estate property in the other country. Many multinational companies invest in the real estate property in the other countries, which helps them to restrain their profits in the form of investments in the other countries. Moreover, it helps them to reduce their tax liability on the profits. This sometimes increases the price of the real estate property in the domestic country as multinational corporations set up their plants in a particular area. Money laundering. The problem of money laundering will be possible when the funds are easily allowed to flow from one country to another country, which can also become the cause of many illegal and criminal activities like terrorist attacks and emergence of black money in the banks of other countries. Black money includes all funds earned through illegal activity and otherwise legal income that is not recorded for tax purposes. To facilitate the effective and efficient international flow of funds, the following agencies have a full support to the system. International Monetary Fund, IMF. The International Monetary Fund is an international organization headquartered in Washington, D.C., consisting of 189 countries working to foster global monetary cooperation, secure financial stability, facilitate international trade, promote high employment and sustainable economic growth, and reduce poverty around the world. World Bank Group. The World Bank is an international financial institution that provides loans to countries of the world for capital projects. It comprises two institutions, the International Bank for Reconstruction and Development, IBRD, and the International Development Association, IDA. The World Bank is a component of the World Bank Group. The World Bank's most recent stated goal is the reduction of poverty. As of November 2018, the largest recipients of World Bank loans were India with $859 million in 2018 and China with $370 million through loans from International Bank for Reconstruction and Development. World Trade Organization, WTO. The World Trade Organization is an intergovernmental organization that is concerned with the regulation of international trade between nations. It is the largest international economic organization in the world. These are the organizations that facilitate the flow of funds from one country to another and in the international markets, and also forms the rules and regulations for all the countries in the world for doing international trade, international investments, and flowing the funds from one country to another. In the nutshell, international flow of fund consists of positive and negative effect to the business operations of one company and to the economy as a whole. But if we are going to see it on a larger context, the internationalization of the funds or money is required and is very necessary for the expansion of the country. It is also important as it play a big role for making an underdeveloped country a developed one. The international flow of funds assists the countries to make themselves technologically advanced and helps them to promote trade between them. This also helps the sellers to sell their products and services in international level, to expand their local brand into an international brand, and to expand their business at an international market, which not only helps the company but also the society as they generate more employment opportunities and provide better quality products to them. So overall, the international flow of funds is good in most of the aspects for the development of a country and the world's economy. Thank you and God bless everyone.